Back in 2001, you could read Enron's profit report and see clean numbers, but you'd still miss the losses that killed the company. About $74 billion in market value vanished. The lesson? Brutal. What blows you up is usually the bill buried under the headline, not the tidy profit line, not the upbeat story. What's interesting? Next, I'll show you the grocery receipt version of this trick. That way, hidden damage gets harder to ignore. You pay $86 for groceries. You stuff the receipt in your pocket. You feel good walking to the car. Then a second strip of paper slides out from underneath. It shows a $19 service fee, a $12 membership renewal, and a $14 charge from last week's return that never processed. Now your cheap grocery run wasn't cheap at all. That first receipt wasn't exactly fake. It just showed the nice part first. And that's the danger. You make your budget from the visible number. You decide whether you can afford gas, dinner, or drinks from the visible number. The hidden bill is what wrecks the plan. That's the Enron lesson in normal life form. The headline says profit. The front page looks clean. But somewhere else sits the ugly charge no one wants you tracking. Not gone, not fixed, just parked out of sight until the toadies suddenly matters. At a card table, acting strong with a weak hand is called a bluff, betting as if you have a strong hand when you don't. In business, the bluff is cleaner. Nobody has to shout. They just move the bad stuff far enough away that your eyes stay on the shiny number. If this reframe helps, subscribe. 2 of these a week. The trading version is closer to home than most people think. Your account can look calm, while the real danger sits off to the side. Maybe you took a position with no exit. Maybe 3 trades all depend on the same news. Maybe the loss isn't visible yet, but the damage is already built in. The pattern is clear. Hidden risk is worse than obvious risk. Obvious risk makes you deal with it. Hidden risk lets you feel smart, right up to the moment the bill prints. So which everyday numbers look safe, even when they hide the damage underneath? Your app says you're up $240 for the month. Green number. Nice little hit of relief. But open the drawer underneath. One trade is down $900. It's still on your screen because you haven't closed it. Another trade is small, but you used leverage, borrowing to trade bigger than your actual account size. So a normal wiggle hits harder than it looks. And most of this month came from one lucky morning at 9:42. Not a repeatable plan. That's how hidden risk shows up. The top line number says profit. The details say fragile. The number that matters isn't just what you made, it's your exposure. How much of your account is at risk on a trade? How much can one ugly move hurt? How much of your capital, your trading money, is tied to one idea? If that idea fails, do you have a clean exit or just hope? Companies play the same game. A headline can look healthy, while the real bill sits somewhere harder to see. Traders do it too. You skip the painful part. You don't take the loss. You move the stop loss a preset price where you automatically get out of a losing trade. You pretend the problem is temporary because the account still looks okay. And that's the danger. Hidden losses don't stay hidden. They grow in the dark until one question decides everything. Do you take the hit now or chase it one more day? Why does taking a small hit feel harder than risking a huge one? Friday night, you're in a cheap poker game with friends. You've already put $20 in. Then the bets get bigger. Your hand is shaky. Your gut knows it. You can throw your cards away, lose the 20 and move on. Poker players call that a fold, quitting the hand to protect your chips from a bad spot. But most people hate that feeling. So you stay in, not because the hand got better, because you want the first $20 to mean something. 10 minutes later, there's $120 in the middle. Your chest is tight. Now you're praying instead of deciding. That's the whole hidden loss problem. Picture 2 folders. One is thin. It says, "We were wrong here. Take the hit." It stings today. The report looks worse today, but the damage stays small and visible. The other folder is stuffed. It says, "Move it somewhere else. Call it temporary. Fix it next quarter." Now the loss is still there, plus interest, plus pressure, plus the temptation to hide one more thing. Same move shows up on a trading screen at 10:42 a.m. You're down $280. The original reason for the trade is fading, but closing it would lock in the pain. So you widen the stop, the exit point that caps your loss. Then you add more money. Then you tell yourself you need a bounce, not because the trade still makes sense, because your ego needs relief. Notice what changed. At first you were managing a bad idea. Now you're managing your feelings about being wrong. That's where accounts blow up. That's where companies blow up too. A clean loss is expensive once. A hidden loss charges rent every day. It eats cash. It eats attention. It distorts every new decision, because now you're protecting the lie, not solving the problem. The thin folder tells the truth fast. The thick folder buys time with money you may not have. Most collapses don't start with one giant mistake. They start with one small loss nobody wants to admit, then another, then a structure built to keep the red slips out of sight. And Enron got frighteningly good at building that structure. Which raises the obvious question, what did they actually do, step by step? October 16, 2001. Enron told the public it was taking a $544 million after-tax charge and cutting shareholder equity by $1.2 billion. That was the first loud crack. Up to that point, the company still looked polished. Enron had reported about $101 billion in revenue for 2000. Its stock had traded above $90 that year. From the outside, you could still mistake size for safety. Now strip away the headlines, follow the trick in plain English. Enron had assets and deals that were losing value. A normal response would have been simple: admit the loss, show it clearly, take the hit. Instead, Enron helped park problems in separate entities that sat outside the main picture. A lot of those were special purpose vehicles, or SPEs. You don't need the accounting label. Just picture a spare closet where you shove unpaid bills before guests arrive. That only works if the closet is really separate. Here was the poison in Enron's version. Many of those structures were tied back to Enron's stock itself. So the thing meant to absorb the damage depended on the same company that was already in trouble. That's like covering one maxed out credit card with a second card that only works if your paycheck never drops. Andrew Fastow, Enron's chief financial officer, was running some of these partnerships on the side while still working at Enron. That conflict mattered. The person helping present the numbers was also involved in the boxes where bad numbers could vanish. Then the chain started breaking in public. On October 22, 2001, the SEC opened an inquiry into the partnerships. On November 8, Enron said it had overstated profits by nearly $600 million since 1997 and needed to restate earnings. That means the old scorecard was wrong. Once people stopped trusting the scorecard, everything sped up. Credit dried up, counterparties backed away. The stock collapsed from around $90 at its peak to well under $1 by late November 2001. Roughly $74 billion in market value vanished. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in U.S. history. Notice what actually killed it. Not one bad quarter, not one unlucky bet, not even one hidden folder. It was the gap between reported strength and real exposure. How much of your account is at risk on a trade? The book said one thing, the buried obligations said another. When that gap gets wide enough, the final loss does not arrive as a surprise. Only the timing does. What's interesting, that's the trading lesson. Your screen can show green profit, your broker statement can look calm, but if you have risk parked in places you're not counting, the account is lying to you. Maybe it's borrowed money from leverage, borrowing to trade bigger than your actual account size. Maybe it's several positions, the trades you currently hold, that all fail together. Maybe it's a stop loss you keep moving because you don't want the red number to become real. Enron's disaster was an extreme case of a simple habit. Hide the pain today, and it grows tomorrow. So the real question is this: before a blowup shows up on the statement, what 3 questions expose it early? We'll deal with that next quarter. That sentence wrecks more accounts than a bad chart. You see it at work. A manager ignores refund requests, so this week's numbers look better. For a day, the report looks clean. The bill is still there. So you need a pre-mortem before you trust any profit number. A pre-mortem means you assume the failure already happened. Call it the pre-mortem rule. Quit the side. If this helps, subscribe. More every Tuesday and Thursday. 3 questions. First, where could the loss be hiding? Off to the side, in debt, in fees, and a trade you refuse to close. Second, if you had to close everything by 4 p.m., what would the honest number be? Third, what exact line proves the story wrong, and what do you do then? A price, a dollar amount, a broken promise from management, something concrete. If you can't answer all 3, the green number means less than you think. Enron looked healthy until people asked those questions. A trade can look fine too. Then borrowed money, hidden fees, or a moved stop turn a paper bruise into a real bleed. The goal isn't to predict every disaster. It's to drag the hidden pain into daylight early, while you still have choices. And once you start doing that, a bigger question shows up. Which other famous blowups were really the same trick in different clothes? Tonight, before bed, pull up one company report or your last trade note. Ask one blunt question: what pain could be sitting off the page? That habit catches trouble before the headline breaks. If these case studies help you spot risk faster, subscribe for more. Next time, we'll open up another famous collapse. We'll show how a tiny hidden problem turned into a very public disaster.